In 1853, during the California Gold Rush, a man named Levi Strauss arrived in San Francisco. He didn't pan for gold. He sold dry goods, textiles, boots, and supplies to miners. The miners needed tools. Strauss sold them. The miners got rich or went broke. Strauss got rich regardless. In 1873, Strauss and Jacob Davis patented riveted denim work pants, later called jeans. By 1900, Strauss's company was worth more than most gold mines. The profit came from selling to the people searching for wealth, not from searching for wealth himself. In 2023, something identical happened. OpenAI released ChatGPT. Suddenly, every company on Earth needed to build artificial intelligence. Tech companies needed GPUs, graphics processing units, to train AI models. The only company that made GPUs at scale was Nvidia. Nvidia didn't invent AI. Nvidia didn't create ChatGPT. Nvidia sold the tools required to build both. By 2024, Nvidia's market capitalization reached $3.3 trillion. The company manufactures semiconductors. It doesn't invent AI. It doesn't deploy AI. It sells the infrastructure. The gold rush made Strauss rich because he controlled the tools miners needed. The AI rush is making Nvidia rich because it controls the GPUs researchers need. The archives show this pattern repeating every 30 to 40 years. The methodology is always identical. Someone discovers a new frontier. Everyone rushes to exploit it. One company owns the tools required for the rush. That company becomes the wealthiest without taking any of the risk. This is the Gilded Archives, where the safest fortunes are built by selling shovels during gold rushes. The records show a system that started in 1993 when Nvidia was founded to make graphics processors for video games. The company went public in 1999 and released the GeForce 256, which they marketed as the world's first GPU. Graphics required parallel processing. CPUs, central processing units, processed information sequentially. GPUs processed information in parallel. Video games needed parallel processing to render graphics fast enough. Nvidia created GPUs for games. The market was profitable but small. By 2010, something changed. Machine learning researchers discovered that GPUs could train neural networks faster than CPUs. The parallel processing that made games fast made AI training fast. Nvidia didn't invent this application. Researchers discovered it. But Nvidia was the only company manufacturing GPUs at scale. In 2012, when deep learning exploded with AlexNet winning the ImageNet competition, researchers were buying consumer gaming cards from Nvidia for AI work. By 2023 to 2024, Nvidia controlled 90% of the AI accelerator market for data centers. Not because Nvidia made the best GPUs, because Nvidia was the only company making GPUs with the mature software ecosystem everyone used. The architecture has 3 layers. First, hardware monopoly. In 2023, when ChatGPT launched, every company needed GPUs. Nvidia's A100 GPU was the standard. The A100 cost approximately $10,000. A company training a large language model needed thousands of A100s. A training cluster could cost $50 million to $500 million. Nvidia didn't sell the cluster. Nvidia sold the GPUs. The cluster required infrastructure. The infrastructure required people. The people required expertise. But everything required GPUs. No GPUs, no training possible. Nvidia had no competition. AMD made GPUs for gaming and data centers. But AMD's AI software, ROCm, was immature. Companies would need to rewrite their code to use AMD GPUs. Rewriting costs millions in engineer time. Staying with Nvidia costs GPU purchase price. The math is obvious. Companies buy Nvidia. Intel made CPUs. But CPUs couldn't train large language models at competitive speed. Intel launched an AI accelerator called Gaudi. By 2024, fewer than 1% of AI clusters used Gaudi. The switching cost meant rewriting code, training engineers, and risking that the GPU won't achieve performance. Companies chose Nvidia. Nvidia didn't need to be better. Nvidia needed to be compatible with existing code and infrastructure through CUDA, Nvidia's Compute Unified Device Architecture software ecosystem. CUDA was the actual mechanism of the lock-in. Nvidia was. The monopoly was locked in. Second, pricing power. In 2023, Nvidia released the H100 GPU. The H100 was designed for AI training. The price was $40,000 per unit. A training cluster using H100s cost $4 million minimum. By 2024, the H100 remained backordered for 9 months, despite Nvidia manufacturing them continuously. The backlog revealed something specific. Companies would pay $40,000 for a GPU they couldn't get, rather than pay $20,000 for a competitor's GPU they could get. The switching cost made Nvidia's price irrelevant. Companies needed Nvidia's CUDA ecosystem. The price became whatever Nvidia charged. By late 2024, Nvidia released the H200, with prices estimated in the $30,000 to $40,000 range. No company refused it because of price. No company had alternatives. The data reveals the extraction with precision. Nvidia's gross profit margin in 2024 was 75%. That means on a $40,000 H100 GPU, Nvidia's cost was approximately $10,000. The profit was $30,000. A manufacturing company typically has 30 to 40% margins. Nvidia had 75%. The margin reflected monopoly pricing, not competition. Competition creates margin compression. Nvidia faced no competition. Nvidia's margins expanded. In 2024, Nvidia's data center revenue was $60.9 billion. The data center division included AI GPUs and related products. Nvidia's data center operating margin was 68%. Operating profit was approximately $41 billion. That profit came from selling GPUs to companies that had no alternative. The profit was pure extraction. Nvidia didn't invent large language models. Nvidia didn't create ChatGPT. Nvidia sold the shovels and captured the value that generative AI companies should have captured. The comparison to historical monopoly reveals the mechanism. Standard Oil's monopoly required controlling oil supply, refining capacity, and distribution. Rockefeller had to build each layer. Nvidia's monopoly required manufacturing GPUs, controlling software compatibility through CUDA, and maintaining switching costs. Nvidia built the GPU manufacturing. The software compatibility emerged from CUDA development starting in 2006. The switching cost made rewriting code irrational. The monopoly was less visible than Rockefeller's, but more complete. Standard Oil could be broken up because alternative refineries could be built. Nvidia's monopoly can't be broken up because building competitive GPUs requires years of software ecosystem development. The barrier to entry is architectural, not just capital. It's invisible. By 2015, Nvidia faced a choice. Deep learning was growing exponentially. Nvidia could control the GPU market for AI indefinitely by staying the only company making competitive products. Or Nvidia could commoditize GPUs and capture value through AI software and services. Nvidia chose to maintain the monopoly. The choice was rational. Selling $40,000 GPUs with 75% margins was more profitable than competing in AI software where margins were 20 to 30%. The monopoly was sustainable as long as no company invested in competitive GPUs. By 2023, when AI demand exploded, Nvidia's choice to maintain the monopoly became clear. The company had become the bottleneck for all AI development. The architect of this structure was Jensen Huang, Nvidia's founder and CEO. Huang understood something that most technology leaders didn't. In technology, control of infrastructure is more valuable than control of applications. Applications are replaceable. Infrastructure is sticky. If you own the infrastructure that everyone depends on, you can charge monopoly prices. Huang designed Nvidia's strategy around infrastructure control. Keep GPUs cutting edge, keep software compatibility strong through CUDA, keep switching costs high for alternatives. The strategy worked perfectly. By mid-2024, Huang's net worth peaked at approximately $118 billion. Nvidia briefly became more valuable than Microsoft or Apple individually, and was worth more than Amazon and Meta combined. The value came not from innovation, but from ownership of the critical bottleneck. Every time a company trains an AI model, you engage with this mechanism. A large, well-funded AI startup wants to build a large language model. Most AI startups rent GPUs from cloud providers like Amazon, Google, or Microsoft, who buy them wholesale and resell access at 3 to 5 times the hardware cost. But the largest AI companies, like Anthropic or Mistral, might purchase GPUs directly. A mega startup might need 10,000 GPUs. That's $400 million in Nvidia revenue, plus hundreds of millions more for the data center build-out, power infrastructure, cooling systems, networking equipment. The GPU cost is significant, but only part of the total capital required. Most of the startup's remaining capital must fund engineers, operations, compute time, and data. Nvidia's GPU cost becomes a substantial portion of total infrastructure expense. The cloud providers who resell GPU access must pass through Nvidia's monopoly pricing as cloud computing fees. Nvidia captures the profit, the startup captures the risk, the cloud provider captures the middleman fee. But there's a second layer the records reveal. If a startup wanted to buy from AMD instead of Nvidia, the startup would need to rewrite its AI code. The rewriting would cost millions in engineer time. The startup could spend $400 million on Nvidia GPUs, or $200 million on AMD GPUs, plus $150 million rewriting code, with uncertainty that the AMD infrastructure would work. The startups choose Nvidia every time. The switching cost is so high that alternatives become invisible. Nvidia doesn't compete on performance anymore. Nvidia competes on CUDA ecosystem lock-in. The monopoly is maintained through switching costs, not through technical superiority. We are at stage 4 of the AI infrastructure monopoly pattern. Stage 1 was Nvidia's GPU invention for gaming in 1993. Stage 2 was the discovery that GPUs accelerated machine learning in 2012. Stage 3 was the explosive demand for GPUs when deep learning became mainstream in 2015 to 2022. Stage 4, where we are now, is the complete monopoly consolidation. Nvidia controls 90% of the AI accelerator market for data centers. The control creates monopoly pricing. The pricing generates enormous profit. The profit is spent on research to maintain technical advantage. Stage 5, which comes next, is the attempted break-in. AMD continues investing in competitive GPUs with billions in annual R&D spending. Google will develop TPUs. Intel will invest in Gaudi. But the switching cost means these alternatives won't break Nvidia's dominance significantly. By 2030, Nvidia will maintain 70 to 75% market share despite competition. The competition will be visible, but ineffective. The monopoly will persist. The 3 paths forward require acknowledging the monopoly's completeness. First, accept the monopoly. Nvidia controls AI infrastructure. Every company building AI must buy Nvidia GPUs or accept inferior performance and higher development costs. The monopoly generates innovation in AI because the margin extraction funds Nvidia's research. Nvidia's research drives GPU capability improvements. Those improvements accelerate AI development. The monopoly is exploitative but productive. Accepting this means recognizing that monopolies sometimes accelerate technological progress because the profit funds research. Most people would choose faster AI development even if it requires paying monopoly prices. Most don't realize they've made that choice because the monopoly is invisible. Second, resist through alternative accelerators. AMD's MI300X costs $20,000 with rewriting costs. Google's TPUs cost $8,000 with rewriting costs. Intel's Gaudi costs $10,000 with rewriting costs. The rewriting costs are real. Companies that invest in alternatives reduce NVIDIA dependency but increase total development cost. This path is available to large companies with sufficient capital. It's not available to startups or small companies. The monopoly extracts most value from companies with smallest negotiating power. Third, positioned by understanding that infrastructure monopolies require maintenance. NVIDIA must continuously release competitive GPUs. If NVIDIA releases an inferior product, companies will invest in alternatives despite switching cost. NVIDIA must also maintain CUDA software compatibility. If NVIDIA software becomes difficult to use, alternatives become attractive. The monopoly requires constant innovation to persist. Positioning means understanding that NVIDIA's advantage is temporary if it stops innovating. The monopoly will persist for 5 to 10 years minimum, longer if NVIDIA maintains technical advantage. It will eventually break when competitors close the switching cost gap. The deeper protection lies in what the archives show always survives monopoly: algorithmic innovation independent of hardware. When computing monopolies existed, software developers created algorithms that worked around hardware constraints. When GPUs were expensive, researchers created efficient algorithms that required fewer GPUs. The records show this consistently. The monopoly doesn't prevent innovation. The monopoly incentivizes innovation around the monopoly. By 2028, most large language models will be trained with 40 to 50% fewer GPUs than current models require. The efficiency gain will come from algorithmic innovation, not from hardware improvement. The monopoly will drive the innovators to work around it. The pattern says, what comes next? By 2028, when efficient algorithms dominate, GPU demand will plateau. Companies won't need to upgrade GPUs as frequently. NVIDIA's revenue growth will slow. By 2030, competitors will achieve sufficient compatibility that switching cost becomes meaningful. Companies will migrate to alternatives for cost savings. By 2035, NVIDIA will control 50 to 55% of the AI accelerator market, down from 90%. The company will remain the largest, but no longer monopolistic. The profit margins will compress to 40 to 50%. Still profitable, but no longer extraction level. The monopoly will have completed its cycle. You start a large, well-funded AI company. You need GPUs. You could rent them from cloud providers like most startups do, paying 3 to 5 times the hardware cost. Or, if you raise enough capital, you buy thousands of Nvidia H100s at $40,000 each. Plus, invest hundreds of millions more in data center infrastructure, power, cooling, networking. You're paying monopoly prices for infrastructure while competitors in other markets compete on their products. You're at a disadvantage, not because your team is weaker or your idea is worse. You're at a disadvantage because NVIDIA controls the infrastructure you depend on. The monopoly worked perfectly. It made itself invisible. It extracted enormous value while appearing to provide a service. It locked in customers through switching costs and CUDA ecosystem dominance. It maintained margins through lack of alternatives. When the monopoly eventually breaks, you'll shift to cheaper infrastructure. You'll experience that as progress. Nvidia will experience it as margin compression. The monopoly will have completed its extraction cycle. If this pattern revealed something you'd never seen before, subscribe to the Gilded Archives. History's records reveal how infrastructure monopolies work. Nvidia isn't unique. It's one iteration of a pattern that repeats across technology, energy, and finance. Understanding it allows you to see the pattern in the next infrastructure monopoly, the next bottleneck that becomes permanent, the next technology that appears inevitable, because the switching cost makes alternatives invisible. The records are specific. The mechanism repeats. The outcomes are predictable. We're just watching it unfold.